Welcome back to Happy Investors, and we are going to talk about 5 cheap stocks at the moment that seem to have attractive valuations and potentially interesting price potential in the longer term. Please note that everything is purely for inspiration to show you with some tools what the characteristics of the stock are. The crucial step that you must always take as an investor is the fundamental research into the management, the business model, the competitive position, and of course, whether they can make more profit in the future, which is linked to the competitive advantage, business model, and such matters. Let's move on quickly. Time is very scarce, of course, and the first stock we are going to look at is Green Brick Partners. The current price level is $60. The fair value estimate from Morningstar is $77. It also receives a 5-star rating. A few analysts, though not many, give a price target of 70. I personally find it advantageous that only 2 analysts cover this stock. Low coverage of a stock by analysts often means an opportunity, as the future development might not yet be fully reflected in the price. Historical valuation suggests that the stock, and if we zoom in a bit, could be undervalued, although this price-to-earnings ratio of 30 is indeed on the much too high side. Let's use a normal multiple of around 10. That seems acceptable to me. It is slightly higher than the 5-year average, but the current price-to-earnings ratio is around 7.4. There are only 2 analysts who expect that this year will be a bad year for Green Brick Partners, but it might recover somewhat afterward. Potential returns could average 15% per year, but we should really focus on the long-term development. However, I can't show that in this tool. If you assume an EPS growth of, for example, 5% per year, which is realistic for such a company with a price-to-earnings ratio of 7, it simply means it's cheap. That doesn't mean that cheap is always cheap. That's another story. Of course, it's up to you to investigate that. Looking at the expectations from analysts, we see that revenue is indeed expected to be low in the coming year, but it might recover. After 2026, not much is forecasted, so we should take everything with a grain of salt. The price-to-earnings ratio is estimated to be low, still around under 8, which I think is on the cheaper side for this stock. The PEGI ratio is estimated to be around 0.3. That is very low. Other valuation figures do not look expensive. In any case, a price-to-sales ratio of around 1 is okay. We actually prefer the price-to-book value to be under 1. It is what it is. The price-to-cash flow ratio is not very favorable at the moment, but that also has to do with the development. Looking at the growth figures for the coming period, they look good. And if we look at profitability, that is, of course, what you want to see. Only high profit margins. The leverage, free cash flow margin is negative. And that is always a kind of, well, yes. A red flag, it's not much, minus 1.6%, but we need further investigation into what's going on here. Do look at profitability. High figures such as, for example, the return on equity based on a 5-year average. I find Green Bay and Green Brick Partners interesting for the longer term, but there are many companies of this kind. So the question is, of course, yes, in the home building sector, what is actually the best choice? And for example, D.R. Horton is somewhat larger, has more competitive advantages, and might also be more interesting. So you also need to thoroughly research this stock versus all comparable stocks of similar companies, and simply choose the best one from the sector. That is something we do not include in this analysis. In the very short term, well, the price has indeed dropped significantly. Find a support level around 53. The last thing you want to use is technical analysis, and you should always look at the fundamental valuation. The stock seems cheap. There appears to be upward potential for the long term, but take into account the cyclical movements in such a market. And yes, significant price drops in the short as well as long term are absolutely a realistic scenario. So maybe it is cheap for a reason, and cheap for a reason often means a value trap. And that is not only for this stock, but for all the stocks we discuss in this analysis. Keep in mind the potential risk of a value trap. The stock, builders, first, source has dropped significantly by about 45% compared to the last all-time high, the last peak in 2024. At the moment, the company might be very interesting, but I think in the short term, so in the coming months, it will probably be the case that the price will likely drop a bit further. This only creates more margin of safety for the very long term. The fair value estimate of this company is around 180, according to Morningstar. They also indicate that it has a small economic moat. 5-star rating, which is high, and analysts on Wall Street think it's a buy with a higher price target as well. What you need to know about this company is that it has an acquisition strategy That is simply a kind of serial acquirer buying up various other types of companies within the construction sector. And with that, of course, it simply tries to offer a full range of building products. And I personally find that aspect of serial acquisition very interesting. As you know, if you do it well with strategic, smaller acquisitions, you can achieve relatively high profitability or return on equity. And even if you don't have organic growth with your business model, you can still achieve growth by making additional purchases. But of course, finances and debts are always an uncertainty in this aspect. The stock price has therefore dropped significantly by about 45%. If we look at the short term, the stock seems to be slightly undervalued, but especially for the long term, because in the short term there is a significant price drop happening. The price to earnings ratio, which was around 15, has now dropped to 10. The 5-year multiple is about 11. You could also say, yes, maybe 15 is a better multiple for this company. I might agree with that, but it's better to make a more cautious estimate. Moreover, these are forecasting tools. This is not absolute truth. So we should always take it with a grain of salt. You know that by now. I repeat that and will continue to repeat it. But it does provide a nice visual to show the potential and a number of scenarios very quickly without all sorts of complicated calculations that people often don't understand. You are a bit more intelligent, I know that, but still, we keep it as simple as possible, even for people who might be seeing it for the first time and want to enter the world of investing, yes or no. So let's use that multiple of 11. And then we see that with this growth forecast, the average return can be about 7.5%. But you see that the expectations are that this will be a bad year. So probably the price could continue to fall further based on this sentiment. And then there might be a better buying opportunity in the future. Well, as you know, if a company is significantly recovering, that multiple will often increase in the short term. So a higher multiple after, for example, 2 years of profit growth is also a scenario. And then you get around an 18% return per year. Let's roughly assume that builders, first source, seems to become interesting based on the current price level. If it falls further, that's just a prayer, and the long-term strategy is so interesting that it can achieve higher profitability on its own equity. We see the analysts' forecasts expecting that revenue will rise again, but the peak in terms of revenue was definitely in 2022, and that is, of course, a natural cyclical movement, as you always see in the construction sector. Valuation figures seem to look good. A PEG ratio below 1 is always good. So from this tool, we also see that there is an expectation that the EPS will grow in the longer-term valuation figures for next year. Because the profit might decrease slightly in the short term, the price to earnings ratio might increase a bit, which is not very favorable in the short term. However, the price to cash flow is still on the low side, no matter how you look at it. They do have some debts, of course. As I mentioned, it is a serial acquirer. So they are making multiple strategic acquisitions within the sector. It has advantages and disadvantages. It must be executed very well. And the downside is if it is not executed well, execution-wise, then you have a problem, especially with some long-term debts, of course. The cash position is also not particularly high, so solvency is always a concern. It adds more uncertainty. Short-term growth figures look dramatically bad. That creates the opportunity, and we see profitability in the long term. So we need to look at, for example, the return on equity. That is currently about 35% lower. This is, of course, related to the poorer figures for the upcoming periods. Return on total capital was also above 15% on average for 5 years. You naturally want to look at what all these figures mean. For that, you also look at compound annual growth rates, which is very important. Short-term cyclical movements are merely a buying opportunity for companies that can continue to grow strongly in the long term. But for that, you need to closely examine the competitive advantages and whether they can maintain, strengthen, or expand that moat, the competitive advantage. And in that, you see, for example, that 5-year figures and also 10-year figures are good for things like revenue and other matters. All right, so that's about profitability. Then, very short term, if you believe in that. What can we say? Well, not much useful, if you ask me. The stock price is dropping significantly and continues to drop a bit, also based on the latest quarterly figures, which were not very favorable. So there might be a sort of buying opportunity around the price level of 106. That actually means a very small price drop. If it continues to fall, there might be a support level around the price level of 90. We'll have to see if it reaches that. But also keep in mind that if the figures are worse than expected, the short term could decline even further. But as you know, all short-term declines for companies with strong long-term growth potential are just buying opportunities. Question for you. Do you agree that this is a good company for the long term? The stock Crocs with the ticker Crocs is cheap and seems to have potentially interesting return potential. As you know, with investors, I research countless stocks weekly, hundreds, sometimes thousands, only with screeners and that sort of things. And what we see at the moment, and one of the methods I use, for example, is also the magic formula. If you're not familiar with the magic formula, there is a book about it, so it's very interesting, and it actually looks at a relatively low, cheap price combined with a high return on assets, particularly return on assets. So it actually looks at, yes, tangible goods. Well, one of the things, one of the stocks that falls into it, and this filter is just free. Go to magicformulainvesting.com. You can submit the minimum market cap here, but in the top 30 at the moment is Crocs. Incidentally, I also see GigaCloud technology in there, in which I also have a very small position myself. Super risky and high uncertainty, and Crocs is also in it. Interesting, small market value, still 5 billion. And what also stands out to me is the high profitability of this company. I am not going to buy this stock. Why? I don't see myself walking in Crocs. I don't believe in product quality. That's why I'm so surprised that they achieve such high profit figures. But belief in the product is very important with these kinds of companies. Because if you're going to invest for the long term and things go against you in the short term, you really need to have a lot of conviction. Conviction that this stock or company, I should say, will grow in the long term. Well, I don't believe in these Crocs shoes, so I simply won't buy it. But the stock does seem interesting. The fair value estimate, by the way, management has also announced buyback programs, which makes it even more attractive. The fair value estimate from Morningstar is $130. The current price is kind around $100. Analysts also expect a higher price target for this company. However, Trump's tariffs will heavily impact Crocs' performance. So I just expect that the short term might turn out to be quite disappointing, which only provides more opportunities for higher returns in the long term. However, the question is, will they grow in the long term? With their Crocs shoes, the historical valuation seems to be quite cheap at the moment. Even if we zoom in on, for example, 7 years, it is below the normal multiple, the blue line, and below the fair value multiple in combination with EPS growth, but that is already very high at 23. So we are not going to do that. Let's just, for the sake of illustration, stick to the normal multiple of 13, and we see an EPS growth estimate that is relatively cheap or low, I must say. So low expectations are always very favorable because then it's easier to outperform. But it is also often an indication that those analysts are not crazy. They are knowledgeable, and often the consensus is somewhat in that direction, but they can also be completely wrong at times. The less known the company, the greater the chance that people are wrong, and the more impact you can have as an investor. With estimates that possibly suggest, yes, listen, this company is really going to grow rapidly for these reasons. So this is a unique buying opportunity. I don't think that's the case with Crocs. So we can go through some scenarios here for illustration that might come close. And the nice thing is that the price to earnings ratio is so low that if you go back to a multiple of 13 with minimal profit growth, then you already have returns based solely on an increase in the multiple. And not just a little bit, almost 100% in total over the coming years, with an average of more than 20% per year. Even if that multiple is still 8, you have minimal growth. With 10, for example, it's a 15% return per year. This is all a bit of speculation. You know how it goes. So definitely do thorough research, particularly on the short-term impact and the long-term potential of these Crocs shoes. But the business model is very interesting. Here we see some expectations from analysts regarding revenue growth, but with declining margins, and a price to earnings development. Set up the image. Pause if you want to see this. Here we see estimates of the multiple development, a PEG ratio that is estimated to be above 1. That is not good. 1.6, cheap. Price to cash flow multiple, that is relatively low. somewhat higher debts, 1.7 billion cash position. Okay, so investigate the solvency in this case. Good figures don't look so good in the short term. The factor analysis is therefore a bit mixed, hence a hold rating. Notably, the revisions mean that the analyst expects the stock to make more profit than at present. That is positive, so it has been revised upwards. That is again a plus. Do we see the profitability? I find that quite remarkable for this business model. Yes, the shoes are low priced. So I think they must have a very low cost price, and they do achieve high margins. I actually find that interesting. By the way, I've been following Crocs for more than a year now, but I just don't buy it myself because I simply don't believe in the product. But that is a very personal taste. Maybe you have had good experiences with Crocs, and then it's a completely different story. But believing in a company is very important when you're investing for the long term, because sometimes the stock is down. One of my largest positions is currently at 20%. I believe in it, so I just keep buying a little more each time up to this point, because I'm not going to keep investing more and more in the company. It's my largest position, but it's not doing very well in the short term. And the same story could be true for Crocs. So it's about thinking long term, and then a cheaper price in the short term is only beneficial. Interestingly, that high profitability, equity return on assets, which we see reflected in the magic formula, comes back again. Yes, high figures in the very short term. There is a kind of support level around 90, or maybe a bit further if it drops to around 80. Then the stock will only become cheaper. And I think maybe it's realistic if those tariffs have a heavy impact on short-term profits, then of course the results won't be good in the upcoming quarterly figures. And as far as I know, those 10% tariffs are still active. It might even become more, or maybe someone will backtrack. We'll see. But at the moment, there are still 10% tariffs. And will that impact Crocs' earnings model in the short term? So keep in mind possible price drops. And with that, the stock could become too cheap for the long term. In our monthly portfolio updates, I have often talked about StoneCo and PagSeguro. I have held both stocks in my position for a long time and have repeatedly bought more, especially after the last dip around the price level of about 7 for both StoneCo and PagSeguro. At that time, I closed the positions in my DeGiro portfolio, but still held them in the Maxim's Interactive Brokers account. Here, still StoneCo, with a value of 5,500, and the purchased stock PagSeguro. What is the analysis about? However, first look at StoneCo, because it has now recovered significantly. And both stocks are very interesting, somewhat comparable, but different types of positions in the market. Only PagSeguro has lagged behind StoneCo a bit and has a long way to go. Based on the charts in 2021, different types of price levels, of course. And yes, that is actually 6 times from the current price level. It has really dropped a lot, as you can see, in the recent period, and now it is picking up again. Earlier, I had bought somewhere around this period, and that is often a pitfall with these kinds of stocks, that you buy them when they actually look a bit better again. Only you should actually buy at times when everyone is in panic. Well, that was actually a while ago, but now the price level is still relatively cheap. Here, too, you see the market value, so I have a position in it. However, the total return on the stock is still only 11%. Through this account, I did not buy more at a lower price level, but I did with my DeGiro account, which I have since closed, because I actually had the same stock in 2 accounts, and then the position became too large. Looking at the historical valuation, we see that at this moment, where in terms of sanding, it was strongly overvalued for a long time, and also had a price-to-earnings ratio above 80. Do we see that now? A completely different story. In the meantime, over the past few years, the company has simply grown, become stronger. The business model has improved, is still scalable, and the price to earnings is around 8. The question is whether you should choose for Particulier and or StoneCo. For example, you also have holdings now, which is actually just the stronger player at the moment. And yes, the winner takes it all is often the case. But still, it may be that Particulier can continue to develop a niche and perhaps keep growing in it. And this is about the theme of cheap stocks, and Particulier is indeed cheap. It also has upward potential. The normal multiple is relatively high. We are not going to use that as a starting point. Let's use a much lower multiple. And below, we see the profit growth expectations from analysts. Because the price to earnings ratio is so low at the moment, there seems to be a bit of a safety margin for a long-term player like us. If we maintain a price to earnings ratio of 11, then the upward potential, as you can see, is 30% on average per year. In other words, a doubling of your money over 3 years. If you have a slightly higher multiple, it quickly increases. For example, a multiple of 16 already meant an average return of over 40%. That could be a realistic scenario. I'm not saying it's going to happen, but it could be. The essence is simply that the stock seems cheap. It seems to be a bargain for the long term, and that is also the question you need to investigate. Will the revenue indeed increase, and especially the profit? Analysts think that the revenue will continue to rise from the scalable earning model that Particular has. Regarding the profit, they also think that the profit margin will increase slightly. Of course, you should also do your own research on this company. I keep repeating that the PEG ratio is below 1, which is favorable. And if the profit growth continues, yes, then the price to earnings will naturally only decrease. But price to earnings is really not the factor you should be looking at. Actually, you should look at the development of free cash flow. Here we see the PEG ratio estimated at about 0.6, still well below 1. The price to cash flow is also considerably cheap. If we look at the balance sheet, the debt is manageable and the cash position is in order. Looking at the growth figures, they appear relatively interesting. And EBIT growth for next year estimated above 20%. Of course, it's also about long-term growth. That goes without saying. Then we see the profit margin. Well, actually, the red flag is that the leverage, free cash flow margin is minus 70%. And it has a negative cash flow. And this has not always been the case with Particular. This is actually a recent development, so this is a concern. Another major concern for this company in the long term is that the costs per new customer are increasing significantly per customer. So you need to watch out for that. What is the potential? Yes, it's difficult, to be honest, but the price level is so low that it could still be an interesting entry point. If the price level ever drops again to 6, then that seems like a strong second entry point. But the question is whether it will ever reach that level again. Any price level around 9 or 8 might be interesting, and there could be a resistance level at 14. Also consider short-term developments, but all in all, Particular seems cheap as a stock. The question, of course, is whether it is also one of the best choices for the long term compared to all the other thousands of scenarios and stocks you can invest in. Well, that's a bit of a complex question to answer. I just think Particular is interesting enough to take a look at, and with a relatively small position, it might grow into a 5-bagger, for example, in the longer term. And then you could achieve attractive returns with relatively small amounts. But Particular is absolutely not in my top 10 favorites. That's what I add to it. A quick note on SM Energy, which is absolutely not a buy recommendation, but more to show that sometimes a speculative idea can be fun to keep following. And here the essence is that you can find a specific niche where you are an industry expert about, for example, from your work experience, your career, or something you just delve into for a long time. Then you can find huge opportunities. I'm not going to claim that SM Energy is that, because I'm not an industry expert in oil either. I do follow some things about it, and I find it amusing to follow. However, it's not really the sector I want to invest in. Still, it might be that oil presents an interesting opportunity, especially due to the recent significant drops in oil prices. But it is a cyclical sector. And then you also have companies that are naturally very dependent because of this. If they also take on too much debt, it can turn out badly in the short term. SM Energy is an example of this. It has taken on a lot of debt for a strategic acquisition around their current location. So that all sounds smart. But of course, it can also turn out very differently, namely badly. Important to know about SM Energy is that their location is the Permian Basin. Delve into that. I think it's interesting to do so if you have an interest in the oil market. Analysts think it's a buy with an upward potential of 70% return per year. Of course, it remains to be seen if that is really the case. Because, for example, Zacks ranks it as a strong sell, and we will soon see why. If you look based on historical valuation, there's really no clear direction. The only conclusion you can draw is clear, strong cyclical movements. And based on that, you see that the downward trend might continue. But that's purely just looking at a few charts. Looking ahead with a tool like fast graphs, for example, isn't really useful for cyclical stocks. These EPS estimates can deviate so much in the short term that it's actually better not to look at them. So what should you do? Research the management. Are they trustworthy? Are they truly building for the long term? How do they handle cyclicality in terms of risk management? What is the debt capacity profile, for example? Well, in that last aspect, SM Energy isn't really the best example. You also see, for example, that the analysts forecasting, well, there's a good chance it wasn't forecasted this way. In other words, they aren't sure either. So why do we mention it? Just for information. To take a look at what might be interesting, because it seems like it's a very cheap stock with a price to earnings ratio of just 4, and for example, a price to cash flow of 1.3. Yeah, where do you find that? By the way, it also pays dividends. However, if we look at the debt position, it's quite substantial. So things might go wrong with everything they've done to increase that debt position. And it has happened before with SM Energy. Still, it could be that if the oil price rises sharply again and also increases somewhat in the long term, then such a risky move with acquisition and work, it can suddenly become a very good mega move. But it also needs to be implemented well, so that's very interesting to investigate further. If you are interested in such a market, it seems that the margins are currently very high, but here too the cyclical story emerges, and we see, for example, a screen pointer to a strong sell. Their price estimate is actually $19 for the next 6 to 12 months. And it is also interesting to see what kind of risks they indicate. For example, the debt position. And another point is the high capital expenditures. So with totally intensive companies, you always want to take a good look at both the balance sheet and the cash flow development. And then you see, okay, this company has a net income. So your company or business is making a profit. However, every year you probably have to invest a large part of your money to keep your business operational. Think of maintenance and maybe new factories, machines. So you have a lot of depreciation. We see that here. And at the bottom line, you actually get that cash from operations. But we have expenditures needed to keep your current business up to date and to renew. And you see that those capital expenditures have risen very high at the moment. However, I do know, and I don't see it reflected here quickly, that they have also invested in acquisitions, but we don't see that here. So probably that is added here in the capital expenditure, but I would also need to think about that myself. Just check what the advantage or the example here is. Please always look at the cash flow and preferably only invest in companies with low capex, so those that are asset light or have an asset light business model. A scalable business model where you need little money to finance future growth, because those are the companies. Yes, that achieve the highest returns, and you often find them in software companies like ServiceNow or others. But also, for example, in well-known examples from Warren Buffett, like Candies, See's Candies, or Hershey Company is such an example. Those kinds of businesses are relatively asset light, but the best are, of course, software companies. However, yes, software companies often have a higher price tag. So that's a different ballgame. So I just want to highlight SM Energy as it seems very cheap based on the multiples. You might wonder what could go wrong, and maybe it is a very good investment. Perhaps in the short term, they actually find a kind of support level here around the current price of 21 to 22. And maybe the oil price will rise, giving it a high upward potential. Then the analysts who indicate that the price target is 40 will be right, which means a 70% return in probably the short term. But maybe it's completely wrong. And you'll see a scenario like the coronavirus crisis, perhaps a bit extreme, but at least it will decline further. And this has happened before in 2014. And then, actually, 2 years later, the price is just a lot lower, as you can see, and it's a very serious price drop. So be careful with what you do, and don't focus solely on price to earnings, because that doesn't say very much. Pay particular attention to the cash flow development about cheap stocks. And the trick is to find what are truly cheap stocks of strong companies for the long term, and what are value traps. And actually, the easiest way to distinguish is, to always look at the company. Think like an entrepreneur. A company needs a few years anyway to be able to grow again. But the best companies have a bit of uncertainty about them, which makes the stock cheap in the short term. Only after much research, that they have a strong earning model, that they have a good market position and can maintain it for the long term, 5 to 10 years. And then you really buy a cheap stock that also achieves profit growth as a company, and profit growth, and cash flow growth. Free cash flow growth, that's also what it's all about, because that's ultimately what you are rewarded for as an investor. Thank you for watching. Let us know. Do you also have cheap stocks in your sights? I am happy to think along with you. I'm also curious. Share it. And do you have valuable feedback? Help other people by sharing your insights. Thank you.